Chapter 7, Bonds and Interest Rates. In this chapter, we are again continuing what we were doing in chapters 5 and 6. The last part of chapter 6 was on different types of loans. In chapter 7, we will continue looking at loans. Let me start with a big picture of what chapter 7 and then chapter 8 will be on. Chapter 7 is on a real-life example of an annuity. So we will see how the annuity calculations fit into a specific type of loans called bonds. Bonds are loans that large corporations have in order to raise money for their projects. And then in chapter 8 that will follow, we will look at a real-life example of a perpetuity where our perpetuity calculations can be used. And that's the topic of stocks or stock shares. Bonds are financial securities sold by companies or governments to borrow money from the public on a long-term basis. So think about how you can borrow money to buy a car, right? You can, go to your bank and ask for a loan for, let's say, $20,000. Or maybe at the car dealership, they have a financial services department, which can also offer you a loan, right? Well, imagine now a large corporation. A large corporation may want to borrow $1 billion, right? Maybe it would like to acquire its competitor. Do you think a large corporation that needs $1 billion can walk into a local bank and ask for that kind of money? It's probably not going to happen, right? Because it's a lot of money. And so imagine if there was a way for that large corporation that needs $1 billion for some major project. Imagine if it was possible for it to borrow a little bit from you, a little bit from me, a little bit from a whole bunch of people in this country, or more, maybe even in other countries. And then all those small loans would add up to a total of $1 billion, right? So this is exactly how large corporations can borrow money in this world. They sell a whole bunch of bonds. Each bond is sold for some amount of money, relatively small, let's say around $1,000 plus minus. And by selling a lot of such bonds, the company is able to borrow the large amount of money that it needs. It could also be a government, like local California government or federal government, that needs to borrow money. And this can also be done by issuing bonds. So bonds is like a long-term loan. So let's say a company that sells a bond is essentially borrowing money from whoever bought the bond from the company, and in return the company will be paying it off with the interest on top, like with any loan, over, let's say, 10 years, maybe 20 years. It could be shorter than that, but generally it's a long-term commitment for the company. Bonds are also known as debt securities because they represent a company's debt. A company owes money to those investors who bought its bonds. And it will be making payments back that will also reflect interest for up to 30 years since the issue. So the seller of bonds, which could be a company, it could be government, is also known as a debtor or a borrower. And those investors or maybe other companies or other governments that buy these bonds, they are lending money, right, to the issuer. So they're called lenders or creditors. This is an example of America's debt. So it's a little bit old. It goes back to May 2016. A figure I found on CNN.com. Who owns America's debt? So this is federal debt that the federal government issued as bonds, and these bonds were sold to whoever would like to purchase them, and the buyers came from all over the world. So who owns America's debt for that time, which is $12.9 trillion? China is the number one lender, 1.3 trillion. Then goes Japan, 1.1 trillion, and then a whole bunch of other countries. And there are other, investors inside the United States which make up the rest of this large $12.9 trillion amount. So this is kind of to give you an idea of who may be, the people or, the agencies, the institutions who buy bonds issued by, let's say, a government. Although in this chapter will be primarily, all our examples will be about corporations rather than governments. So let's say a company or a government borrows money from the public by selling bonds, right? And so the price at which each bond is sold at is exactly how much was borrowed by that company or government with each bond sale. And in return, kind of like with interest-only loans that were covered in the previous chapter, the corporations or the government will be paying back regular loan payments that reflect interest. It's actually more like interest-only loans. So the company or the government will be paying interest periodically, and at the very end, it will also pay the borrowed amount in one large chunk. Bonds have their own terminology. Face value or par value or simply par. Coupon rate, coupon payment or simply coupon. Maturity date or time to maturity. And yield to maturity or simply yield. So let's discover on the next slide what these terms refer to. The payments that pretty much reflect the interest payments on the borrowed amount of money are known as coupons or coupon payments. When the last coupon is made, at the same time, the borrower will also pay, the borrowed amount of money, which is known as the face value. It's actually may or may not be exactly equal to how much is borrowed at time zero. We will see that in the next examples. The time between today and when the last payment will be made is known as the time to maturity, abbreviated as TTM. Face value can also be called the principal value or the par value or simply par. And in most of our examples, we will be using $1,000. So even if it's not given, you should always assume that the face value is equal to $1,000. And this is true for most corporations and government bonds. Some government bonds have a much larger face value, but unless specified, you should assume $1,000. Next, how are coupon amounts calculated? There is always one extra information that is given, known as the coupon rate, some percentage, let's say 5%. You take that percentage, the coupon rate, and multiply it by the face value, which, as was just explained, is usually $1,000, right? So let's say the coupon rate is 5%. You multiply it by $1,000, you get $50. So that's the coupon that will be paid at the end of the first year, at the end of the second year, third year, and fourth year. Every year, the same dollar amount. And one more thing that is typically given for bonds. That's the discount rate, or IY in the financial calculator. When we talk about bonds, we call that yield to maturity, abbreviated as YTM, or simply yield. So this is also something I found on morningstar.com. It's also a little bit old, about a year or so old. It shows the capital structure of Starbucks for that time. The orange area reflects what is known as equity, and the dark blue area reflects the amount of debt. So this figure shows that in March 2017, the proportion of debt, how much money Starbucks owes to others, is a little over 41% of total money that it has on its hands. And the historical proportions of debt to equity are similar to that. Now let's look at a little bit more detail on, debt, what exactly it looks like for Starbucks. So at that time, March 2017, this is the kind of bonds that Starbucks had. And notice that I didn't say bond, it's bonds. And by plural, I don't mean that there are many bonds. There are actually many different types of bonds, and each type has many bonds, right? Like the count. For example, we see 1, 2, 3, 4, 5, 6, 7 rows in this little table. These are different types of bonds. For example, the percentage here, 3.85%, is the coupon rate, right? It's also repeated in the coupon percentage column, 3.85%. The second row shows 2.1% coupon rate, right? So you would take this percentage and multiply by $1,000 face value. That would give you the coupon amount paid every year. Then maturity date, another column. For example, the first type of bonds matures on October 1st, 2023. This means that this is when the very last payment will be made by Starbucks to the bondholders. In the second row, the maturity date is February 4th, 2021. Again, that's when the last payment would be made. Then we also see different amounts in millions of dollars, right? So there were different amounts of money borrowed at different points of time. And in the maturity date column, we see when the last payment would be made for each group of bonds. And so on. So there are, different characteristics of this 1, 2, 3, 4, 5, 6, 7 different groups of bonds that Starbucks owns. And in the last column, you can also see how the yield to maturity, which is the discount rate or IY, differs for all these different categories. For example, you may notice that the yield to maturity is by far the highest, 3.99%, for the bonds which have a very long time left until they mature, which is the year 2045. And this is probably because there's so much uncertainty about what will happen in the economy between now and the year 2045 that whoever buys such bonds, they commit to basically a lot of uncertainty between now and the year 2045. And because of so much uncertainty, or in other words, risk, those bond buyers require a compensation which comes in the form of a higher return on their money, which is essentially the yield to maturity on such bonds. So there are like a lot of stories that could be told when we compare different groups of bonds. So now let's look at like a different side of bonds. So let's say today there is a company that sells bonds. So again, let's continue talking about Starbucks. So Starbucks decided to sell bonds. Why? Because it needs to borrow money for something that's important for its business. Let's say it sells bonds to Mr. Connery. Then Mr. Connery, he bought these bonds. Maybe they have 20 years to maturity, but he's actually not obligated to hold these bonds for such a long time. He's free to sell these bonds at any time he likes. And let's say at some point he sells his bonds and their new buyer is Mr. Brosnan. And then Mr. Brosnan again can sell his bonds at any time he likes. And let's say they end up in Mr. Craig's hands, and so on. So bonds switch hands. The ownership changes, all the time. Have you noticed the strange last names? Well, remember James Bond? Hint, hint, bonds. That's what this chapter is about, right? Okay, so back to financial securities, right? So what am I trying to say with this, sort of timeline? What I'm trying to say is that bonds can be resold. Somebody sells them, another investor buys them, right? One thing remains: when these bonds mature, when the last payment would be made by Starbucks to the bondholder. Another thing that remains constant throughout the years is the coupon rate, let's say 5%, that determines the coupon payment every year, as well as the face value, which is the additional dollar amount that will be paid at maturity on the very last date. But one thing that will be changing throughout these years is the price on the bond, right? So maybe Mr. Connery sold the bond for $900, but Mr. Brosnan then sell these bonds for $1,200 to Mr. Craig. So the price fluctuates. Okay, so now let's look at the price. What determines the price on a bond? Well, the price should reflect how much a bond is worth, or the bond value. And each bond should be worth no more than how much money it brings you in the future, right? So you would never want to pay more than what you're expecting to get from it, from the company that issued the bonds. So what is the bond value? How much should each bond sell for? How much money does the firm raise or borrow with each bond? These three questions ask you to calculate the same exact thing, right? So we usually call it bond value, calculating bond value, or bond valuation. And like was shown earlier, what you get in the future when you buy a bond is annual coupon payments, as well as the face value at the very end. And you will continue receiving those coupon payments until maturity. So you look at the amount of time that's left, and then that becomes part of our calculations. So what are the calculations that we need to do? Well, the coupons are constant. They will be repeated every year, and they will eventually end. This is the definition of an ordinary annuity. So we have that as part of the cash flows from a bond. And we also have the face value at the very end, like a single cash flow, right? Sort of by itself. So to find how much you would be willing to pay, or the maximum you would be willing to pay for a bond today, if you are on the investor side, on the buyer side. And if you're on the firm side that's selling the bond, the question could be rephrased as how much the firm should sell each bond for. So that becomes nothing but the present value of all the coupons, the annuity of coupons, plus the present value of the face value at bond's maturity. So we just add up the two sort of components of the bond value. And so the bond value is equal to the sum of the present value of an annuity of coupons and the present value of the face value at maturity. And the formulas are from, the annuity formula from chapter 6 for the coupon part, and for the face value part, it's kind of going back to chapter 5, discounting a single cash flow back to time zero. Okay, let's do our first numerical example on bond valuation. Golden Eye Company, that's one of the James Bond movies, right? Issued bonds with a coupon rate of 10% and annual coupons. The par value is $1,000 and the bonds have 5 years to maturity. The yield to maturity on similar debt issued by similar companies is 11%. What is the value of each bond? This question could be put in different words. How much money can the company raise with each bond? Or how much should the company's bonds sell for in the market? It's all one and the same thing. So 10% coupon rate determines the coupon amount every year. The face value is given as $1,000, which is the same thing as the par value. This could be completely omitted, in which case you would assume that the face value or the par value is $1,000. And another important thing that I haven't mentioned yet is what's important for bond valuation is how many years are left until maturity. For example, maybe these bonds were sold originally 7 years ago, right? Which means 7 years until now plus another 5 years from now until maturity makes it originally 12-year bonds. But we don't use 12 years for our bond value calculations, but we only use how many years remain until maturity. That's important. So always make sure you're using the number of years between today and the maturity date, the remaining time until maturity. Okay, so the coupon amount is always calculated the same way. You take the coupon rate and you multiply it by the face value. Both are given 0.1 coupon rate multiplied by $1,000 face value. That gives the annual coupon amount of $100. And we have now everything we need to compute the bond value. We can either plug in the numbers into the formula or use the financial calculator. So let's see how that's done. If you use the formula, then you will get $963.04. And now the formula. The formula is, now the financial calculator. The financial calculator uses the same keys as an annuity. You enter the coupon amount, $100 is the PMT, and so on. But one extra thing that needs to be entered now is the $1,000 future value. Okay, so let me bring up the financial calculator and explain how we solve this kind of problem. This is the financial calculator. Turn it on. It's always a good idea to clear everything, even if you used your calculator a few days ago. Second, plus, minus, enter, does a full reset. Now we are ready to go. Maybe we also want to increase the decimal places. Let's do that. Second decimal place, let's make it not 2, but maybe 6. I press 6, enter, it's done. And if I turn the calculator off and turn it back on, it's keeping 6 decimal places. Okay, now let's begin. Again, in no particular order, as always, you enter the information that is given. And now there are 4 numbers that need to be entered. With annuities, in chapter 6, it used to be 3 numbers, N, IY, and PMT. Now there is an extra number that needs to go into the calculator, the face value or the future value, $1,000. So our coupon payments will be $100 each every year. You put 100. As usual, we make it negative and save as PMT. Then not only will we be receiving $100 coupon payments if you buy such bond, but we are also going to receive $1,000 at the very end. So let's enter that as our next piece of information. 1,000. And because it's just like coupons received by the bondholder, you use exactly the same sign. So we made PMT negative. You're also gonna make your future value negative. So you press the plus minus key and then you press FV. So FV stands for future value, but here it's also the face value when we talk about bonds. And then in no particular order, you enter the discount rate, 11%, which is also known as the yield to maturity when we talk about bonds. So I press 11 IY and 5 for N. 5 is how many coupons there will be between now and the maturity date. So 5N. And we want to compute the present value of this bond. $963 and a little bit more than 4 cents, right? So the new thing here is entering the face value, which is FV, future value. And it's always $1,000. And the important thing is, like I explained on the slide, both the PMT, the coupon amount, and the FV, the face value, must be entered with the same sign. So I showed how you enter both as negative. What if you didn't? What if you left them as positive? The only thing that would be different is that when you get your bond value, the answer, right, on the display, it would be displayed with a negative sign. Otherwise, it would be still the same dollar amount, $963.04. So let's continue. In chapters 5 and 6, we saw that whenever the interest rate or IY is higher, the present value is lower, right? So there was this negative relationship between the discount rate or the interest rate and the present value. And it remains true when we talk about bonds, right? Why would it be any different? It's the same. So IY, the interest rate, is called yield to maturity, and the present value in the context of bonds is the bond value, what we just did. So there is again a negative relationship between the yield to maturity and the bond value. So let's actually, kind of prove it. What we just did was an example with the yield to maturity, the interest rate, right, of 11%. We had 5 years to maturity, $1,000 face value on the bonds, 10% coupon rate. And the present value that we found earlier was $963.04. What if we lower the yield to maturity, the interest rate, from 11% to 10%? The negative relationship tells us that that should make the bond value higher. And if we repeated the financial calculator keys and only change the IY from 11 to 10, we would get the higher bond value, and that would be $1,000. If you make the yield to maturity, the IY in the financial calculator, even lower, then the bond present value will become even higher because of the negative relationship between the two. And if we redid the calculations in the financial calculator, we would get the following answer: $1,079.85. That's the bond value at 8% yield to maturity, right? So as we lower the yield to maturity, we increase the bond value. So that's a negative relationship, just like what we saw in chapters 5 and 6. With a single cash flow or with multiple cash flows. Now notice how in the second example on this slide with the 10% yield to maturity, the bond value became exactly $1,000. Is it a coincidence? No. Turns out that whenever the coupon rate and the yield to maturity are identical, right? In our example, they are both 10%. You will always get the bond value of $1,000. You will always have $1,000. Even if the coupon rate is, let's say, 15% and the yield to maturity is 15%. As long as they are the same, you will always be getting $1,000. So if you know this trick, if you're given the same percentages for the coupon rate and the yield to maturity, don't even spend your time calculating the bond value. $1,000 is your answer. We also say that the bonds that sell at $1,000, which is their face value or par value, these bonds sell at par. If they sell for less than their par value, then they are known as discount bonds, right? So $963.04 is a discount bond. So it's like if you're an investor and you're buying such bond, which was issued by some company, you're kind of buying it at a discount, because when in the future you'll be receiving your interest payments, known as coupons, and then the last lump sum payment at the very end, which is $1,000, it's kind of like, you're lending less than what you're getting back. So you're lending $963, but you're getting back $1,000 in future value, in face value, together with all the interest until then. If instead the bond present value is above $1,000, like in the last case with the 8% yield to maturity, right? $1,079.85. That kind of bond is called a premium bond. And just to repeat again, whenever the yield to maturity or IY, right, like the discount rate, is above the coupon rate, you're always going to get the bond value below $1,000. That's a discount bond. If the yield to maturity and the coupon rate are the same percentage, you will always be getting $1,000. These bonds are said to sell at par. And premium bonds are the ones that are worth more than $1,000, and that's always going to happen when the yield to maturity is less than the coupon rate. So this is like, a little rule that you could always keep in mind when you do the calculations. So why does it even let's make a step back. What we just did was calculating the bond price or bond value for different discount rates. Why did we actually have to do all that? And that's because in the real world, interest rates are always fluctuating. We are going to cover this towards the end of this chapter. Why? There are different things that are happening that get reflected in interest rates on bonds. So at this point, let's just, take it as given. Interest rates fluctuate over time. And because they do, bond value will also constantly fluctuate over time. And what this in turn implies is that if you bought a bond yesterday and paid some amount of money for it, then maybe if the interest rate went up overnight, then your bond value went down overnight. So what you paid a lot of money for yesterday is not worth as much money today. So as an investor, because of these constant fluctuations in interest rates on bonds, you're facing this risk of your bond value going down unexpectedly. Technically in finance, we would use the word risk when the price unexpectedly goes up. So any sort of fluctuations are referred to as risk in finance. And we call it interest rate risk. So people who buy bonds issued by corporations or governments, they face this so-called interest rate risk. So it's the fact that the value of the bonds on their hands will be fluctuating whenever interest rates change. Turns out that when you buy bonds, right? So now you're a bond holder, you own bonds. And so it turns out that your bond value will be going up and down, right? So fluctuate significantly more if the bonds that you hold have a longer time to maturity, or if they have a lower coupon rate. So let's see what's the intuition behind these, two factors that affect the interest rate sensitivity of bond value. Let's consider this figure. This is figure 7.2 in our textbook. On the horizontal axis, we have the interest rate. That's the yield to maturity, the IY in the financial calculator. On the vertical axis, we have bond value in dollars. Then we know that the relationship between the interest rate and the bond present value is negative, right? We just had it on one of the earlier slides. And that's why we see the lines sloping down and to the right. Now, why are there two lines? Why not one? Because we are comparing two bonds. The green line is a downward sloping line for a bond that has 30 years left to maturity. It's a 30-year bond. The blue line, which is a lot less steep, is for a different bond, which has only 1 year left to maturity. So it's kind of, a very long-term bond and a very short-term bond. What do we see going on here? Imagine you changed your interest rate, the yield to maturity, the IY in the financial calculator. So you change it, let's say, from 5%, increase it to 10%, then increase it to 15%, then increase it to 20%, and recalculate the bond value for each of the two bonds. When you do that, so you will be getting new numbers for the bond values, right? If you plot the results on this figure, you would get these two lines, the blue line and the green line. The blue line for the 1-year bond, which is almost flat, and the green line for the 30-year bond, which is a lot steeper. Right? So it kind of comes from the calculations that you can actually, try doing yourself. It could be a good practice. And so bottom line, the steeper line for the 30-year bond, the bond with more time left to maturity, has a much higher interest rate sensitivity. So the bond value is very sensitive to changes in the interest rates, in the yield to maturity, right? Whereas the 1-year bond with a flatter line has little fluctuations in bond value when the interest rate is changed, right? There's almost no effect on the bond value. It's always around $1,000 on this figure, even if we double or triple the interest rate. So make it from not 5% but 10% or 15%, right? The bond value is still very close to $1,000. So very small drop in bond value. So that's the interest rate sensitivity depending on how much time is left until maturity. That's what this figure summarizes. And the intuition, I just said that you can verify that this is what will be happening. If you try changing the interest rate and recalculate the bond value and see how big the changes are. But there's also a different kind of an intuitive explanation for why this is happening. So consider a longer time to maturity bond. If it's, let's say, a 20-year bond or a 30-year bond, which will see coupons being paid over 20 or 30 years, right? Then the $1,000 face value is at the very, very end of this long time period, right? And the $1,000 face value is by far the largest cash flow on our timeline because the coupon payments are significantly smaller. So those would be maybe $50 a year, maybe $100 a year. And because the largest dollar amount, the largest cash flow, the $1,000 face value, is at the very end when we discount it as, part of finding the bond value, we end up discounting it very heavily. And so any slight change in the interest rate will dramatically affect the present value of the face value of the bond. So if the interest rate goes up, the present value will go down by a lot. And so because it's a huge portion of the, the sum of all cash flows on the bonds timeline, we end up observing a higher sensitivity of bond value to changes in the interest rates. Turns out there is another factor that plays a role. We get exactly the same higher sensitivity of bond value to interest rate changes if we have a bond with a lower coupon rate. And actually, the interpretation is, the intuition is exactly the same as earlier with longer term bonds. So think about what a lower coupon rate bond really means. If the coupon rate is low, right, some small percentage, like 3%, 2%, then relatively to the coupon payments, the $1,000 face value will seem like a huge number, right? So the face value is a much higher fraction of all bond payments on the bond payment timeline. And then the rest of the intuition is just like on the previous slides where we looked at the effect of the time to maturity. So because the face value is at the very end, it's discounted very heavily. And so since it's a huge fraction of all bond payments between now and maturity, any slight change in the interest rate dramatically affects the face value, the present value of the face value, which in turn plays a huge role in determining the bond value, right? And so a bond with a lower coupon rate will fluctuate in its value a lot more when interest rate changes. So we observe a higher sensitivity of bond value to changes in the interest rate. Next, this topic is called current yield. What is a current yield on a bond? Think of it as a 1-year return on your money when you buy a bond that some company or government issued. So a 1-year return is what you get back in 1 year divided by what you paid for that, financial security today. So you take, to calculate the current yield, you take the coupon payment, which is the money you will get between now and end of the first year, and you divide it by the price of the bond that you paid today. So this becomes the first year return on your money. So let's say the coupon payment is $100, right? And the price is $900. You take 100, you divide by 900, and you get something around 11 and something percent. So that's your first year return on your money. It's not, current yield sounds a lot like just yield, which is another term for yield to maturity, but it's not the same thing as yield to maturity. In our previous examples, with the coupon rate of 10% that determines the coupon amount, $100. And then we varied the interest rate, the yield to maturity, from 11% to 10% and then to 8%, right? And we got 3 corresponding bond values. So to calculate the current yield in those 3 similar scenarios, where the only difference was the interest rate, the yield to maturity, we take the $100 annual coupon payment and divide it by separately by each of these 3 prices. And we get the current yield of 10.38%, 10%, and 9.26%. In this country, bonds usually pay coupons semi-annually, so 2 coupons every year, one after the first 6 months and the second one after the second 6 months. Let's do an example. Let's say we have Quantum of Solace Corporation, another one of James Bond's movies, is raising money for new investments by issuing corporate bonds. The bonds have the following characteristics: 10 years to maturity, 8% yield to maturity, 12% coupon rate, and coupons are paid semi-annually. Same question as in the previous problems. How much can this corporation raise with each bond? In other words, we are asked to calculate the bond value. We have a 12% coupon rate, so as always we can multiply it by a $1,000 face value, which will give us $120 in annual coupon. Except because our coupons are now semi-annual, we get half of that every half a year. So every half a year, whoever buys such bond will receive a $60 coupon. We have 10 years left to maturity, which means there will be a total of 10 times 2 or 20 coupons paid between now and the maturity date. And this is what we will use for N in the financial calculator, because remember, in the financial calculator, N refers to how many recurrent payments we will have. Our recurrent payment is $60 repeated over and over every half a year. And we need to use N that reflects how many of those we are going to have. And to be consistent, everything throughout our calculations of the bond value should reflect this semi-annual frequency. So for the IY, the interest rate, the yield to maturity, we need to use this semi-annual interest rate. If per year it's 8%, which is given, then we need to divide it by 2. And 4% is the correct discount rate that we will use. So plugging these numbers into the bond present value formula will give us the bond value of $1,271.80. This is a premium bond because it costs more than $1,000. And of course, you can do it in the financial calculator. So let's do it together. Let's clear everything we had from our earlier calculations. Let's also increase the decimal places. Let's try second decimal place. Let's make it 6. Enter. Let's begin. So in no particular order, we need to enter the future value or the $1,000 face value, PMT, the dollar amount of each coupon payment, the number of coupon payments, N, and the discount rate or the yield to maturity, IY. So let's start with the face value. 1,000, we are making it negative, right? Press the plus minus button and save it as FV. The same sign should be used for the coupon payment. What is our coupon payment? Every half a year, it's $60. So you put 60, you change the sign to negative by pressing the plus minus key, and then you save it as your PMT. Then, how many of those recurring coupons will there be? A total of 20 coupons. You use that for N, 20 N. And the fourth number that is entered is the discount rate. It should also reflect the same semi-annual frequency, 4% yield to maturity per half a year. So I put 4 IY, and I'm computing present value, $1,271 and about 80.5 cents. So technically, if it's rounded to 2 decimal places, then that would be 81. If it's rounded to 1 decimal place, like on my slide, it's just 0.8 at the end of the answer. So keep consistency. If you have semi-annual coupons, you need to adjust kind of 3 things. The coupon is the annual coupon divided by 2. The number of coupons, number of years left to maturity multiplied by 2. And the discount rate, it's the annual yield to maturity divided by 2. These 3 things, all 3 must be made in order to do the calculations correctly. Solve for yield to maturity, or YTM. Sometimes, like in real life, we actually know how much bonds sell for, which was our bond value calculation from the early slides. And sometimes what investors are interested in is calculating the implied yield to maturity, which is like the rate of return on your money every year, or the IY in the financial calculator. One way to calculate it is trial and error using the formula and trying different interest rates until you get the present value that is known. But of course, there is a way to do it very easily in the financial calculator. Let's look at the following example. Skyfall Company issues corporate bonds to raise money for a new investment project. So it would like to borrow money, essentially. The bonds that this company issues have the following characteristics: 10 years to maturity, 9% coupon rate, coupons paid semi-annually, and the company can raise $880.50 with each bond. What is the yield to maturity? Okay, in the financial calculator, we are given 10 years, but we are going to have to input 20 for the number of coupons, right? Just like before. For the PMT, the coupon amount, every year, we need to do 9% coupon rate multiplied by 1,000, which gives $90 per year. And then to make it semi-annual, we divide $90 by 2 and get 45. So that's our PMT. Then, as always, the future value is $1,000, and this time we are given the present value, which is $880.50. And we are gonna have to compute the IY, the yield to maturity, in this problem. Notice one important thing. We are given $3 amounts, the PMT, the FV, and the PV. What do you do with the signs? Everything that's today is one sign, everything that's in the future is with the opposite sign. For example, the way I put my signs here is I left both PMT and the future value, which are both in the future, as positive, and I changed the sign to a negative for the present value. But you can also do it the other way around. When you do that, you will get 5.5%. It looks like this is our answer, right? Actually, it's not. We are missing one more step. Why? What's going on here? Because everything in our problem is semi-annual, the interest rate we get is also semi-annual. So 5.5% is for half a year. And what's really meant by yield to maturity is the annual interest rate, the annual yield to maturity. And so the last step that we need to do is multiplying our answer by 2 to convert the answer to its annual equivalent. And so 5.5% per half a year multiplied by 2 gives 11%. This is the right answer. Let's do this math in the financial calculator. Let's bring it up, turn it on. First, let's make sure it hasn't stored anything from any earlier calculations. Let's reset it. Second, plus minus, enter. We can also increase the decimal places. And we do that by pressing second decimal place. Let's make it 6. 6, enter. And I just turned the calculator off and then back on. And the calculator is now going to round everything to 6 decimal places. So we need to solve for the yield to maturity, or IY, in the financial calculator. And we need to enter the number of coupons, which is 20. So 20N. Then the coupon amount itself, or the payment, PMT, is 45 PMT. Because I left it as positive, my $1,000 face value, or the future value, should also be positive. So I put 1,000, and without changing the sign, I press FV. And only for the bond price, or the present value, I'm gonna change the sign to negative. So I put 880.50 negative PV. And I'm computing IY, compute IY. So we get 5.499965. If you round it to 2 decimal places, we will get 5.5, like on my slide. And then you multiply that by 2 and get the annual yield to maturity, 11%. Bond features. So a bond is like a loan. A company that sells a bond borrows money from whoever bought the bond from the company. Indenture means a written agreement between the company that borrowed money and bondholders who lent money, the creditors. This written agreement includes a lot of conditions and terms. Let's look at the most important ones. The most basic ones are terms of the bond. For example, what is the face value amount? Usually it's $1,000, but it could be something else, for example, $100,000. There are bonds like that. Then how many years are left to maturity? When, on which dates the coupons will be paid to the bondholders? What is the coupon rate? And so on. Security. Bonds are called secured if they have some sort of collateral, in case the company cannot meet its obligations and pay the coupon and the face value to the bondholder. So what could be a collateral? Maybe if the company cannot pay cash as coupon payments, it instead pays in stock shares. Or maybe it uses something else as a collateral, maybe some sort of accounts receivable. Unsecured bonds are also known as debentures. And this is basically what this whole chapter is on. We never talk about any sort of collateral. So it's more like unsecured bonds are like, just a promise from a company, from the company that sells the bonds, that it will make the required coupon payments and the face value at the very end. Technically, in this chapter, we call all the different types of bonds as bonds, but anything that has less than 2 years to maturity is also known as bills. 2 to 10 years to maturity is also called notes. And anything with longer than 10 years to maturity is just bonds. But all of this combined is also called bonds. Another thing that could be included in the indenture is the type of seniority on these bonds. Bonds are called senior bonds if they are older bonds. They have been issued way back when. So maybe a company issued bonds a few years ago and today decided to issue more. Those bonds that were issued a few years ago are senior bonds. Those that are about to be issued are junior bonds. So those investors who bought the senior bonds that were issued a few years ago, they have a preference in receiving payments over those investors who are going to be buying the junior bonds. So the junior bonds are basically more risky. They present more risk to those who buy them because there is a chance they will not receive their promised coupon payments in the face value, since they get the second priority. Repayment. So we have a company that sells bonds. We have investors who buy those bonds. There could be a third party, a sinking fund, like a third party between the company and the investors. The role of a sinking fund is the company will be making annual payments into this sinking fund. So it could be some sort of bank. And then this bank, this sinking fund, will use the money that will accumulate in it to, so to speak, retire part of the bonds. In other words, it will buy them back from the market, from the investors' hands. They're no longer circulating, among the investors. They're removed from the market. And this is called as calling bonds. And the point of that, so why would the firm want to use this kind of option to call the bonds? Because if there are fewer bonds in the market, then it's like the firm has less debt. So this may improve its credit score, which is good for all sorts of different things. These sinking funds may be used after several years. And some bonds have this provision of the possibility that they would be called sometime in the future. Types of bonds. So let's look at different types of bonds. But of course, we're not going to be talking about James bonds, but instead corporate bonds or government bonds. So bonds can be of different type. On this slide, I'm summarizing the types of bonds by issuer. Who may issue a bond? A corporation or a government. So there are corporate bonds, there are government bonds. The government bonds can in turn be issued by the federal government, and those bonds would be known as treasury bonds or treasuries, or they can be issued by more local governments, such as State of California, City of Pomona, and those are known as municipal bonds or munis. And again, there are different variations in how bonds may be called. Bills, if they have less than 2 years to maturity, notes, if they have 2 to 10 years to maturity, and simply bonds if they have a longer time to maturity. How do corporate bonds and different types of government bonds differ in terms of risk of default? So what does risk of default mean? Defaulting means you're not able to make your payment. So who are we talking about? The issuer, a corporation or a government. So in which case do you as an investor who bought a bond face this risk of default? If you bought a corporate bond, you face a low to high risk of default because any company can go out of business. It may go bankrupt, it's out of money. So you may not get your coupon payments. In case of the government bonds, the risk is smaller, and there is no risk of default if you buy federal government bonds. In other words, you will get your coupon payments and the face value in the future. But if you buy local government bonds or state government bonds, there may be, a chance that the state is out of money. The state budget is, low, and you don't get your coupons, maybe not for a while. The second thing that makes corporate bonds and government bonds different from each other is whether you, as an investor who buys such bonds, need to pay taxes on your coupons, because coupons that you receive is your, additional income, right? Is it taxed or is it not taxed? Yes, it is taxed if you bought corporate bonds or federal government bonds, but your coupon income is not going to be taxed if you're buying state and local government bonds. So see how all the different bonds, are different in many different ways. Let's look at this example in which the whole taxability of coupons on bonds is analyzed. Spectre Corporation has bonds that give a 7% return per year. So that's their yield. Municipal bonds that an investor could buy instead yield a 5% return per year. So let's say we have investor James, who is in a 30% federal income tax bracket, right? So any income is taxed at 30% rate. Would he prefer buying Spectre Corporation's bonds or the municipal bonds? So at the first glance, it looks like his return would be higher if he buys the Spectre Corporation's bonds, right? So we are talking about 7% being above 5%. But wait a second, remember, corporate bonds are taxed. So it could be that after taxes, the return on these corporate bonds is below 5%. So let's check that. So we need to compare the after-tax or the effective returns to this investor. Corporate bonds are taxed, and so after taxes, the return will be only 4.9%, which is calculated by taking the before-tax return, 7%, which is given, and multiplying by 1 minus 0.3, the 30% tax rate. And the municipal bonds are not taxed. The coupons received from municipal bonds are not taxable. And so the effective rate is as given, 5%. And now you can see which bonds would be more desirable for this investor, James. It's the municipal bonds with a higher after-tax return. There is another type of calculation that could be done when we are comparing bonds with taxable versus bonds with non-taxable coupon payments. For example, we can calculate at which federal income tax rate an investor would break even. In other words, be indifferent between buying corporate bonds and municipal bonds. And what we need to do is basically set equal the after-tax yields. So after-tax yield on the corporate bonds with the 7% yield that was given would be equal to 7% multiplied by, open parenthesis, 1 minus some tax rate, close parenthesis. And that needs to equal 5%, which is given for the municipal bonds. So we are asked essentially to calculate the tax rate that would make both sides equal to 5%, right? The after-tax return on the municipal bonds is 5% as given, and so is the after-tax return on the corporate bonds. To solve this little equation, we can first move 0.07 to the right, and mathematically we would be dividing 0.05 on the right hand side by 0.07. And now on the left hand side we are just left with 1 minus t. And then we want to have t equals and then everything else. So we want to get rid of 1. And the easiest way to do it is to leave t on the left hand side. Actually, I first simplified the fraction. So 0.05 over 0.07 equals 0.7143. And then t will equal 1 minus 0.7143. And when you simplify it, you get 0.2857. In other words, the tax rate that you would need to face in order for you to be indifferent between buying corporate bonds and municipal bonds would be 28.57%. And this is kind of the general formula that you would apply in problems like this. So to find the break-even tax rate, you do 1 minus a fraction where in the numerator you have the percentage yield on municipal bonds, and in the denominator you have percentage yield on corporate bonds. Next, we can group different bonds into different categories determined by how coupon payments are made. So coupon bonds is what we have had in this chapter so far, and we will look at coupon bonds until the end of this chapter. That's when there are coupons, and that's the most common type. So there are coupons periodically, typically every half a year, right? Semi-annual coupons, with the face value paid at the very end. There are bonds which have no coupon payments. They're known as zero coupon bonds or zeros. So there's just the face value at the end and one large interest payment together with the face value. Then bonds that do pay coupons can further be differentiated by the coupon rate. Level coupon bonds have a level coupon rate. So what does level mean? On the same level, flat, so unchanged or fixed. And that's also what we've been using in all our numerical examples in this chapter. So it's the same coupon rate which we then use to calculate the same amount of coupon payment paid regularly. Other bonds in real life have a floating coupon rate. So those are known as floating rate bonds or floaters. So the coupon rate sort of floats. It goes up and down. In years when it's high, we have a high coupon payment. In years when the coupon rate is low, we have a low coupon payment. So the coupon rate is adjustable over years. What could it be linked to? It could be linked to sort of the cost of living or inflation. So if the prices are higher, then investors would want to be compensated with a higher coupon payment to them, right? And in those years, the coupon rate will be adjusted up. Now that we mentioned the word inflation, let's talk more about inflation. In general, when we talk about interest rates, we can talk about so-called nominal interest rates and so-called real interest rates. Nominal interest rates is what we've had so far. Same thing as a quoted rate or a stated rate, the rate that's given. What is a real interest rate? It's the rate that's adjusted for inflation. Let me start with a simple example. Let's say you put your money in a bank account that offers a 5% interest per year, right? And so at the end of the year, you'll be 5% richer, right? If you leave your money there for the full year. But let's say something else is going on. during this year. Everything you typically buy gets more expensive. Let's say everything is 3% more expensive at the end of the year. So how much richer do you really get with a 5% increase in your money at the bank and 3% higher prices? You probably already figured out that you'll feel only 2% richer because 3% is kind of eaten by inflation. And this is correct. So we say the nominal interest rate is 5% that you earn in your bank. The real interest rate is only 2%. And the difference is the 3% inflation that sort of erodes the value of your money. Now let's look at it a bit more formally, because actually the math I just explained is only approximate. So let's see how we would do it more accurately. Let's start with something simple. You deposit $100 in your bank account. The interest rate that the bank offers to its depositors is 10% per year. We also know that prices are expected to rise over the next year by 3%. That's inflation. The inflation rate is 3%. The question is, what rate of return do you really earn at your bank? In other words, what is the increase in your purchasing power? So how much wealthier do you really get by the end of the year? So let's imagine this timeline with 2 points of time marked on it. This year, or right now, and next year, 1 year later. And let's talk about this whole purchasing power concept. What it really means is how much stuff you can buy, so in units. For example, let's say you're buying jeans, and since we're talking about $100 to be put in your bank account, let's say to buy one pair of jeans today, you would need to spend $100. So what is your today's purchasing power in terms of pairs of jeans? You have $100, you divide it by the price to buy a pair of jeans, so 100 divided by 100 gives 1. Your purchasing power the purchasing power of your $100 today is 1 pair of jeans. You can use $100 that you have now to buy 1 pair of jeans, right? And now let's calculate how that would change in 1 year. We're going to use the same steps. Your purchasing money will equal the money you have in your bank account in 1 year divided by the price for a pair of jeans next year. We know that the bank pays you 10% interest, so your money in the bank will increase by 10% compared to today's $100, right? So we have $100 times 1 plus 10%, just like in chapter 5, a single cash flow, future value. And we divide it by the price for a pair of jeans next year. We were given a 3% inflation rate. So the jeans will cost $100 times 1 plus 3%, which is $103. So now we have 110 divided by 103, and that equals 1.068 pairs of jeans. So today your $100 can buy 1 pair of jeans. Next year, you will be able to buy only a little, 1.068 pairs of jeans, a little bit more, which is a good thing. These two circled numbers, so 10% increase in the money in your bank, right? And 6.8% increase in the purchasing power are the two types of interest rate that we are now differentiating on these slides. 10%, like a pure increase in the money you have, right, in the bank, is the nominal interest rate. And you might recall that the word nominal came up when we were covering the topic of effective annual interest rate. So that's how the financial calculator calls the stated rate. It was nominal. And then the increase in the purchasing power, which is 6.8%, right, over 1 year. That reflects how much wealthier you really get, considering the increase in the cost of living. and that's the real interest rate. And if you look at, the numbers that we use to find the real interest rate, you can kind of cancel out the $100, right? They become unimportant. And so what really determines the real rate is the fraction with 1 plus the nominal rate divided by 1 plus the inflation rate. Another thing you can notice is that the difference between the 10% nominal rate and the 6.8% real rate is 3.2%, right? And that's approximately, it's very close to the 3% inflation that was given. So 1 plus the real rate is calculated by taking 1 plus the nominal rate and dividing that by 1 plus expected inflation rate. Using notations, the real rate is lowercase r, the nominal rate is uppercase R, and you can think of it as the nominal rate typically being higher, so it's an uppercase, and you divide by 1 plus h, so h stands for inflation rate. Because there are 3 notations in this formula, there are 3 things you might be asked to solve for, either the real rate or the nominal rate if the real rate is given, or the inflation rate if both the real and the nominal rates are given. So we can rearrange this formula to solve for lowercase r, uppercase R, or h. This formula here that calculates the nominal interest rate is known as the Fisher effect. So the nominal interest rate, uppercase R, equals 1 plus lowercase r, and then that whole thing is multiplied by 1 plus h, and then we subtract 1. If instead we rearrange the original formula to solve for the real interest rate, or the lowercase r, you would get a fraction with 1 plus r in the numerator, 1 plus h in the denominator, and then you subtract 1. If instead you want to solve for the inflation rate, which is lowercase h, then you also have a fraction with 1 plus capital R nominal rate in the numerator, and in the denominator you have 1 plus lowercase r, or the real interest rate, and then you subtract 1 from the whole thing. These 3 are like the most accurate ways to compute the real rate, the nominal rate, or the inflation rate. The approximate versions are these. For the real rate, you do nominal rate minus inflation. To find the nominal rate, you do real rate plus inflation. And to find the inflation rate, you do nominal rate minus real rate. This will give you approximate answers, which are a little bit off. So in our example, we had a 10% nominal rate, a 3% inflation rate, right? If we are asked to find the real rate, we could do it using the exact Fisher effect or using the approximate Fisher effect. By plugging in 10% and 3% into these formulas, we get 0.068, like we had earlier, and 0.07, right? So this is the approximate real interest rate. Let's look at this example. These days, the interest you earn in your checking account is pretty small. It's very close to 0. So let's say last year, in the year 2018, you kept your money in a checking account which was offering a 0.5% interest. I looked up the data on an official source, the Bureau of Labor Statistics, to see what the inflation was like in the year 2018. And this figure here shows that for all the things you are buying for your everyday life, which includes food and paying for gas for your car and everything else, the prices went up by approximately 1.9%. What does it mean? So let's answer the following question. how much richer did you really get in 2018 if you earned a 0.5% interest on the money in your account, but prices went up by 1.9%. So let's do the math both exactly and approximately. Let's start with the approximate solution. To find the approximate real rate of return, you need to take the nominal rate and subtract the inflation rate. That's 0.005 minus 0.019, which gives a negative 0.014. That's the same thing as a negative 1.4%. So you lost 1.4% of your money. What does it mean? You might as well just have spent it last year, because if you didn't, you would have lost it, and you did. This is how much you really lost. That's how much less the money could buy you. The exact formula gives a very similar number, and this is actually the most accurate result. Negative 0.0137 or negative 1.37%. So this is the loss in your purchasing power. This is how much less stuff your money was able to buy you at the end of the year 2018 relative to how much you could buy at the beginning of the year 2018. Let's look at another example. You want a 10% real return. You expect inflation to be 8%, and the question is, what should be the nominal rate of return on your investment, right? So what should be the nominal rate of return so that your real return is 10%, considering the 8% expected increase in the cost of living? So here, 10% is the real return, and we need to find the nominal rate. So it's the capital R that we need to solve for. The approximate solution is real rate plus inflation. So we add together 10% and 8% and get 18%. The exact solution will be just a little bit more complicated. So you would do 1 plus the real rate. Then you multiply that number by 1 plus the inflation rate, and then you subtract 1. So 1.1, that's 1 plus 0.1 in decimals, the real rate, times 1.08, which is the same thing as 1 plus 0.08, the inflation rate. And then you subtract 1. And when you simplify it, you get 0.1880, or 18.8%. So approximately 18%, exactly 18.8%. The two answers are pretty close. I would say always use the exact formulas, because that's how you get the right answer. Anything else is only approximate. So don't use the approximate formula unless you're asked to find an approximate answer. Just always stick to the exact versions for all the formulas we had. And the last topic in chapter 7 on bonds is related to called term structure of interest rates. So let's recall what we had so far in chapter 7 on bonds. We looked at what bonds are. It's basically a way to borrow money. A company can borrow money by selling bonds, or a government can borrow money by selling bonds. We looked at how to calculate bond value. Then the topic of inflation that we just finished has to do with yield to maturity, the IY in the financial calculator, right? The return on your money when you buy a bond. Now this topic, term structure of interest rates, goes in a little bit more depth into this, how the nominal interest rate on bonds, or IY, is determined. Term structure of interest rates, so the word term means the number of years. So time to maturity, how that determines what the nominal interest rate on a bond would be. There are three important factors that affect the nominal interest rate for different bonds. First, the real interest rate. So when investors are buying bonds, why do they do that? Because they want to end up with even more money in the future. They want to get some return. So there's this bare minimum return that investors would like to get. That's the real return, right? The real interest rate. We already know what it means. So they want to be able to buy more stuff with their money. So the real interest rate captures that adjustment to any possible inflation in the future. So regardless of how long the time to maturity on the bond is, whether it's only 1 year or 10 years or 30 years, we want some bare minimum. So you can imagine this, flat line with the years to maturity on the bond on the horizontal axis and the nominal interest rate on the bond on the vertical axis. The second factor that affects the nominal interest rate for bonds is called inflation premium. Inflation premium means, let's say, investors think that, or there is this general belief that prices will keep going up, which is probably true in real life, right? Then, if you're buying bonds with more years to maturity, you will want to get a higher return so that you are compensated for that increase in cost of living in the future, right? If you instead hypothetically expect the prices to go down over time or a deflation, then bonds with a longer time to maturity can offer a lower return to their investors, right? We don't need that compensation for the higher cost of living because that's the opposite of the expectation of inflation in the future. And now you can combine the first two factors and sort of imagine stacking these lines on top of each other. So you have the flat line from the real interest rate that we desire, and you take the upward sloping inflation premium line and add it on top. So now we have this upward sloping line shifted up by the amount of the real rate. The third thing that's also very important is something which we already had earlier in chapter 7, interest rate risk premium. So what we had earlier in this chapter was the idea that turns out that bonds that have a longer time to maturity fluctuate in their price a lot more when there is any slight change in interest rates. And so what this implies is that if you're an investor, if you're buying bonds and the bonds you're buying have more time to maturity, you know that your bonds will be fluctuating in their value up and down a lot compared to bonds with fewer years to maturity. And so because you'll be facing this interest rate risk, you will want to be sort of compensated or rewarded with what? Rewarded with a better return on your money. That's why we have this upward sloping line, which basically summarizes the idea that when you're buying a bond with more years to maturity, you want to be compensated with a higher return, right? To offset this interest rate risk. And now we have 1, 2, 3 factors, and you can sort of stack the 3 lines we get on top of each other and get something like this. Upward sloping term structure or relationship between the time to maturity on a bond and what the nominal interest rate for it should be. The line slopes up in which the 3 factors are sort of put together. It could be a downward sloping term structure, a downward sloping line, but that's only because we expect deflation. So the inflation premium goes down. I would say this is an unrealistic case because we all know how things are only getting more expensive over time, right? Most things we buy, they get more and more expensive. Apart from those three factors that determine the nominal interest rate for bonds with different times to maturity, we have three more additional factors, but they're not true for all bonds. They're true for some bonds, but not all. For example, on one of the earlier slides in which we looked at different types of bonds, we saw that corporate bonds and municipal bonds have a risk of default. So corporations and local governments that issue bonds may go bankrupt. And so investors who buy those bonds may not get their promised coupon payments, right? And so if you are an investor who are buying corporate bonds, then you are aware of the fact that you're facing this default risk, right? And so you're only going to be interested in buying the corporate bonds if you're compensated appropriately. And the compensation will again come in the form of a higher return on your money. So corporate bonds and municipal bonds, those that include this default risk, right? They have this default risk embedded in them. They will be offering a better return, so a higher nominal interest rate, than the other types of bonds. So what's left here? The federal government bonds. Then number 5, again, this is a factor that is true for some bonds, but not all. So we had corporate bonds, federal government bonds, and municipal bonds. Corporate bonds and federal bonds pay coupon payments that investors will need to pay tax on. Investors that buy local government bonds, they don't need to pay taxes on that additional income, right? The coupon payments that they receive. And so in order to make corporate and federal government bonds attractive to investors, the return must be higher. That's the taxability premium. And the last thing that actually never came up anywhere in this chapter is known as liquidity premium. So what else could investors require a compensation for? Some bonds are difficult to find. They're not traded very frequently. That's corporate bonds and municipal bonds. Federal government bonds are actually traded very actively, so they're very easy to buy or sell. And so corporate and municipal bonds that don't sell very frequently are said to be not very liquid. And because of that, investors who are willingly buying corporate or municipal bonds are only doing that because they know they're compensated. So liquidity premium is basically that extra, like a little bit of return. So maybe another 0.5% or whatever that might be, that investors receive when they buy bonds. So to summarize all these words, premium. So what does premium really mean? It's an additional return, a little bit more higher percentage. So maybe another 0.25% here and there. So that's the extra percentage return that some but not all bonds have, depending on whether the bond issuer may default or not, whether you as an investor are required to pay taxes on your coupon income or not, and whether the bonds you're buying are liquid, so easy to find, easy to buy or to sell or not. And here we see an example of term structure of interest rates for federal government bonds. So on the horizontal axis we see 1 month, 3 months, 5 years, 10 years, 30 years. That's time to maturity, right? And on the vertical axis we have yield in percent. That's the yield to maturity. That's the nominal interest rate for bonds with different maturity. The line slopes up, which means it's an upward slope in term structure. So for all those various reasons, and we have a total of 6 of those summarized on the last couple of slides, federal government bonds that mature after more years offer their buyers, their investors who buy them, a better return, a higher nominal return. The lower line on the bottom here is the real rate. So the difference between the higher line, the nominal rate, and the lower line, the real rate, is the expected inflation. So we can even calculate. It's roughly a 2% inflation 30 years from today. And this graph is about a year old. So it's from end of December 2017. Let's summarize chapter 7. We looked at bonds. That's how companies and governments can borrow money. For bond calculations, we did 2 important things. How much a bond should sell for, or finding the bond value. For that, we need to know the coupon rate that allows us to find the coupon payment, the PMT, in the financial calculator. The time left to maturity, so between today and when the bond will mature. That allows us to find the number of coupon payments, or N. Yield to maturity, that's another term for discount rate or interest rate. We also refer to it as the nominal interest rate in this chapter. That's IY in the financial calculator. And we also need to be given the face value, which becomes our future value, FV, in the financial calculator. The face value is typically $1,000. So you should always assume it's $1,000 if it's not even given. Then we looked at how we would instead calculate the yield to maturity, IY, when the bond present value is known. We also looked at so-called interest rate risk. So bonds which have either a longer time to maturity or a lower coupon rate fluctuate in their value a lot more when interest rates change. We looked at different types of bonds. Some bonds don't pay any coupons. They're known as zeros. Other bonds that pay coupons pay varying amounts of coupons. They're known as floating rate bonds. Then coupons are taxed. So you as an investor, when you receive your coupons, do you need to pay taxes or not? You do need to pay taxes. Do you need to pay taxes on the coupon payments you receive or not? You do have to pay taxes on your coupons if you bought a corporate bond or the federal government bond. If you bought a municipal bond, you do not need to pay taxes. So for municipal bonds, coupons are not taxed at the federal level. Then we looked at the topic of inflation. And the formula we had is known as the Fisher effect. It says that when you earn some return on your money, whether it's in a bank or some other investment, but when at the same time the cost of living is going up, your ability to buy stuff with your money is sort of, eroded by this inflation rate. And so the real or the true interest rate you earn in a bank or in some other investment is approximately equal to the nominal interest rate that the bank quotes minus the inflation rate. This is the approximate Fisher effect, and we also saw a different version of it in which the calculation of the real interest rate is done more accurately. And then we looked at the so-called term structure of interest rates. So that's 6 factors that determine the nominal interest rates for bonds with different time left until maturity. And to finish chapter 7 on bonds, this is the James Bond Island. It's in Thailand. I traveled there in December 2011. This is me right here. And I saw this very famous island. I think it appeared in actually a lot of movies, but in particular in one of the movies with James Bond. And that's where this informal name came from.